So you want to buy a football club. Not invest in one from a distance, actually own it. Your name on the paperwork, your money in the account, your decision on who plays center forward. Picture it. You buy the crest, you hire a manager, you sign a global superstar, and 80,000 people wear your team's shirt and scream your player's name every single week. You imagine open days, kids in your team's kit, your face on the back page. It feels less like buying a business and more like buying belonging. Sounds simple. It is not simple. Here's the thing nobody tells you before you sign the check. In almost every other major sport on earth, owning the team is one of the safest bets in business. Buy an NFL team, an NBA team, an MLB team, and the league is closed. A fixed number of franchises. No one new can ever join. No one can ever be relegated out. Add a salary cap, so no rival can simply outspend you into oblivion, and the value of that franchise has historically only moved one direction, up. Football does not work like that. Football is open. There is no cap on what a rival can spend to beat you. There is no fixed membership protecting your seat at the top table. Finish in the bottom three of your league, and you don't lose market share. You get physically relegated out of the competition that made you valuable in the first place. That's worth sitting with. The team that wins it all can be playing in a different league, in a stadium a third empty 11 months later. And here's where the paradox gets stranger. The single most valuable prize in the entire sport, the biggest trophy of a club there is, cannot be bought. Not for $10 billion. Not for any number at all. We'll get to why. But by the end of this video, you'll understand something almost no fan thinks about while they're watching a match. The clubs that look like the safest, richest, most glorious assets in world football, and the clubs that go bankrupt and disappear. Those are not opposite stories. They're the same bet, priced at two different ends of the table. So, how much does it actually cost to sit down at that table? Let's start with the price of admission. In 2008, Abu Dhabi's ruling family bought Manchester City through a company called Abu Dhabi United Group for just over £200 million, enormous money at the time. 13 years later, in 2021, a Saudi-led consortium bought Newcastle United for around £305 million. Then in 2022, Roman Abramovich sold Chelsea to Todd Boehly and the investment firm Clearlake for £2.5 billion in share price alone, plus another $1.75 billion pledged into the club over the next decade. Total deal for £0.25 billion. Read that again. In under 15 years, the going rate to own an English football club climbed from £200 million to $2.5 billion. By 2024, when businessman Jim Ratcliffe bought just 25% of Manchester United, that quarter alone cost about £1.3 billion, valuing the whole club at somewhere around $4.3 to $5.4 billion. Not for the team, for a slice of it. And here's the twist in that number. It still wasn't enough to buy the club outright. Months earlier, a Qatari bidder had offered close to £4.8 billion for the whole thing and walked away. The deal never happened. Just a number showing what outright now costs to even attempt. The price of a seat at this table has gone from $200 million to nearly $5 billion in under 2 decades. That's the scale of the modern game. But here's where it gets interesting, because there's a very short list of the richest clubs on earth, ranked every year by the accounting firm Deloitte. In the most recent count, the top 20 clubs in world football generated a combined €12.4 billion in a single season. And exactly one of them cracked €1 billion in revenue on its own for a second year running, Real Madrid. Roughly $1.2 billion, the only club in the sport ever to do it. So naturally, you'd assume Real Madrid is the crown jewel you're trying to buy. Here's the twist. You cannot buy it. Not for $100 million. Not for $10 billion. Not at any price a human being can name. Real Madrid is not a company. It's never sold a share to an owner. It's been owned, since its founding, by roughly 95,000 of its own members, its socios, who vote for the club's president the way a country votes for its head of state. Spanish law lets a handful of historic clubs, Real Madrid and Barcelona among them, stay this way forever, exempt from the rule that professional teams must be private companies. Say that out loud, and it sounds absurd. The single biggest prize on the entire scoreboard of world football, worth more than any other club by revenue, by trophies, by global reach, is the one club you are structurally locked out of buying. It isn't expensive. It isn't complicated. It simply is not for sale. And here's the number that tells you what you're actually buying everywhere else on that scoreboard. Analysts have valued Real Madrid at somewhere in the $6.5 billion range, a figure that works out to roughly 6 to 8 times its annual revenue, not 6 times its profit. Profit in football is thin to non-existent. 6 to 8 times revenue. That's worth sitting with. You're never buying a football business priced on what it earns. You're buying a brand priced on what it represents. Keep that thought. It's the thread running through everything else in this video. With a football club, the bleeding starts before a single ticket is sold. Say you buy Manchester United. In the 2023-24 season, the club's total wage bill, salaries before a ball is kicked, was £201 million. Divide that by 365 days, and you're burning roughly £550,000 a day in wages alone. Win, lose, or no match at all. £500,000 gone on a day with no match on the calendar. And wages are only the most visible part of the burn. Across the Premier League that same season, clubs spent an average of 64% of all their revenue on wages alone. Some run far hotter. By one estimate, Everton spent roughly 91% of revenue on wages in a recent season. Chelsea, around 87%. Manchester City sat at 59, Arsenal at 51. Same sport, same league, one club spending nearly double the share of its income just to field a team. There's supposed to be a ceiling on this number, except the ceiling keeps moving. European football's governing body only wrote a hard wage limit into law in the 2020s, phased in at 90%, then 80%, heading toward a permanent 70% by 2025 to 26. The Premier League is building its own version too, 85% league-wide, 70% for clubs in Europe from 2026 to 27. Even the rule meant to stop the bleeding is still being rewritten in real time. But wages aren't even the sneakiest cost. Here's where it gets interesting. When a club buys a player, it doesn't book the fee as an expense the day it's paid. It spreads the cost evenly across the contract, a piece of accounting called amortization. Take N'Golo Kante's £32 million move on a 5-year deal. That's not $32 million spent in year one. It's $6.4 million a year for 5 years, as if the player were equipment slowly depreciating in a warehouse. But actually, here's the flip that makes this genuinely strange. When a club sells a player, the profit is booked immediately and in full. Manchester City once bought the forward Robinho for £32.5 million on a 4-year deal. 2 years later, having used up only about $16 million of that fee on paper, they sold him for $18 million, booking an accounting profit of roughly $1.7 million. On paper, a win. In cash, the club had burned tens of millions on a player who lasted 2 seasons. The spreadsheet and the bank account tell 2 different stories, and football's accounting lets both be true at once. Now add the physical cost underneath it all, the stadium. Tottenham Hotspur's new stadium cost roughly £1.2 billion to build. By the end of 2023-24, the club still carried £851 million in outstanding loans against it, some running past 2050. Real Madrid tells the same story, dressed differently. Its Bernabeu renovation was budgeted at €400 million in 2014. By 2025, the real total had ballooned past $1.3 billion, more than 3 times the original number, funded by a loan the club is only just beginning to pay down. And here's the detail almost no one catches. Real Madrid proudly reports a debt-to-equity ratio of 0, maximum solvency, the healthiest balance sheet in the sport. That figure excludes the stadium debt entirely. The wages bleed daily. The stadium debt bleeds for decades. Keep an eye on that building. It's going to come back. So if wages and stadium debt are eating you alive every single day, where does a football club's money actually come from? Ask any fan, and they'll give you the obvious answer: the tickets. The 40,000 people walking through the turnstiles every other Saturday, buying pies and pints and replica shirts. That is the bait, and it's smaller than you think. Break down the top 20 clubs in world football by where their money actually comes from, and matchday income, tickets, food, merchandise sold inside the stadium on the day, is the smallest of the three buckets. Broadcast revenue is roughly 38%. Commercial revenue, sponsorships, kit deals, is the largest bucket at 43% and has been for 3 years running. Matchday, around 19%, less than a fifth. That is not a typo. The one revenue stream a fan can actually see and touch, the ticket in their hand, is structurally the smallest slice of the pie at every major club in the sport and has been for years. And even the biggest piece of that slice is capped by design. In the Premier League, domestic television money isn't simply handed to whoever's biggest. Half of it is split equally across all 20 clubs, regardless of size. A quarter is based on how many times a club appears on TV. Only the final quarter is tied to where a club finishes in the table. Even the league's own commercial sponsors get split evenly, roughly £7.9 million to every single club, top of the table or bottom. But here's where it gets interesting. Even broadcast money, the bucket everyone assumes rewards winning, is partly a redistribution scheme. The league itself is quietly protecting smaller clubs from bigger ones, on purpose. But look closer at the clubs just outside the true super club tier, ranked 11th through 20th on that same scoreboard, and broadcast money jumps to nearly half of everything they earn versus about a third for the top 10. The smaller a big club really is, the more it depends on television money it doesn't control, which means the more exposed it is if that money ever disappears. We'll come back to exactly what happens when it does. For now, sit with this. The thing that feels like the business, supporters in the stadium, paying to watch, is the bait. It gets you in the building. It is not why the building exists. So if tickets aren't the real business, and even television money is split like a welfare check, where is the actual profit hiding? Here's where it gets interesting. Start with broadcast rights, because they've quietly become bigger than most fans realize. The Premier League's domestic UK television deal for 2025 through 2029 is worth £6.7 billion, about $1.675 billion a year, mostly to Sky. But that's not the whale anymore. International broadcast rights, the money paid by every other country on Earth to show Premier League football, have risen 23% to roughly £2.17 billion per season. Add domestic and international together for 2025 to 26 alone, and you're near £3.84 billion. Total value of the whole 4-year package, £13.2 billion. Look at that split again. International broadcast money now outstrips the league's own home country's TV deal by roughly 30%. The hometown television check, the one every fan assumes is the big one, isn't the biggest check anymore. The rest of the planet is paying more to watch English football than England is. Then there's commercial revenue, sponsorship, kit deals, growing faster than the other two buckets combined. Barcelona's kit deal with Nike runs €1.7 billion over 13 years, reportedly the largest kit sponsorship by total value in the sport's history. Manchester City's deal with Puma is worth more than $1.3 billion in total, over £100 million landing every single season. Real Madrid pulls in around €300 million a year from just 3 headline sponsors, Adidas, Emirates, and HP combined. None of that money depends on how many people show up to a match. It depends on how big the brand is on a screen anywhere in the world. But here's the trap almost nobody sees coming, and it might be the strangest business inside this business. Some clubs make more money developing and selling players than they'd ever make from a season of ticket sales. Take Benfica in Portugal. Over one recent 10-year stretch, the club generated roughly €743 million in pure transfer profit, buying young, often South American, talent cheap, developing it, and selling high. The midfielder Enzo Fernandez cost Benfica €44.25 million, a club record. Chelsea bought him 6 months later for €121 million. Do the math on that. 6 months. Almost triple the price. That single trade alone likely made more profit than most clubs see from an entire year of matchday income. Benfica isn't a one-off. The striker Darwin Núñez cost the club €34 million. 2 seasons later, Liverpool paid €85 million for him. You don't need a state's oil money to run this playbook either. Brighton and Hove Albion, a mid-sized English club, posted the biggest single-season profit in Premier League history. £122.8 million, almost entirely from selling players its own data-driven scouting model had flagged as undervalued, in leagues nobody else was watching closely. So here's the real shape of the trap. The ticket you bought to watch the match is the bait. The television deal nobody notices, the sponsor logo on the shirt, and the transfer market quietly trading human beings like appreciating assets. That's the business. The football itself is almost incidental to how the money actually moves. Here's a part of this business most fans never see at all. The ownership structure itself is built around 4 completely different definitions of what winning means. The first you already know can't be bought. The members club, like Real Madrid or Barcelona, where the fans themselves are the shareholders and the president works for them. The second is the leveraged buyout, and Manchester United is the textbook case. In 2005, Malcolm Glazer bought the club not with his own money, but by borrowing roughly £600 million against the club itself. The debt didn't belong to Glazer. It belonged to Manchester United. Now watch what the debt actually did. Over the following 2 decades, interest alone on that debt cost the club over £1 billion, money that never bought a player, built a stand, or paid a wage. It just served a loan the club never chose to take out. Meanwhile, the Glazer family has extracted more than £150 million in dividends from the club over that same stretch. Think about that for a second. The team loses money on the pitch. The family that owns it still gets paid. The third model is sovereign ownership. Abu Dhabi's ruling family bought Manchester City in 2008. Saudi Arabia's public investment fund took majority control of Newcastle in 2021. Qatar's state investment arm has owned Paris Saint-Germain since 2011, spending roughly $1.2 billion on transfers along the way. Analysts have a name for the pattern: sports washing, using a beloved club to launder a country's global reputation. But actually, here's the flip that should bother you more than the label does. When a state owns the club, return on investment isn't even the goal. Reputation is the return. Profit and loss on the balance sheet is almost beside the point. The fourth model is the one country that legislated against all of this. Germany's 50+1 rule requires club members to hold a majority of voting rights at every Bundesliga club, blocking any outside investor from taking full control. One reason German ticket prices have stayed low while English ones climb for decades. Football also built rules to referee all this spending, a financial fair play system capping how much a club can lose. Premier League clubs may lose no more than £105 million over any rolling 3-year window. Break it, and the penalty is real. Points deducted straight from your position in the table. Here's where it gets interesting. In 2023-24, Everton was docked a total of 8 points across 2 separate breaches of that rule. Nottingham Forest was docked 4 points for going £34.5 million over the limit, a deduction that dropped them straight into the relegation zone. Meanwhile, Manchester City is facing 115 separate alleged breaches of Premier League financial rules, a case still unresolved years after it was first brought, with the league itself reportedly spending over £200 million just fighting it. Notice the pattern. 2 mid-table English clubs got caught, and punished within months. The state-backed case, arguably the far larger alleged breach, remains open years later. The regulation seems to catch the clubs that can't afford to fight it, not the clubs with the deepest pockets on earth. Every business has a worst-case scenario. Football's is called relegation, and it's more brutal than almost anything in American sport because there's no salary cap and no closed league to catch you when you fall. Here's the mechanism. Drop out of the Premier League, and you don't lose your TV money gradually. You fall off a cliff, then get handed a rope on the way down. Parachute payments, tapering over 3 years, roughly 55% of a full share in year 1, 45% in year 2, 20% in year 3. But here's the trap almost nobody sees coming. Your wage bill doesn't taper on the same schedule. Player contracts run for years. You build a squad to survive in the Premier League, and now you're paying Premier League wages on championship income. That mismatch, not one bad signing, not one bad manager, is what actually kills clubs. No club shows this more starkly than Portsmouth. On the 26th of May, 2008, Portsmouth beat Cardiff City 1-0 in the FA Cup final at Wembley. Harry Redknapp's side, David James in goal, Sol Campbell and Sylvain Distin at the back, lifted the trophy and earned the club's first ever European qualification. It was the greatest moment in Portsmouth's history. And the timing is the whole story. Within days of that trophy going up, owner Alexander Gaydamak, caught out by the 2008 financial crash, began pulling funding and selling the club's best players just to service debt. The club's greatest triumph and the beginning of its collapse were not two chapters. They were the same week. What followed was a death spiral, for different owners cycled through in a single season. On the 26th of February, 2010, Portsmouth became the first Premier League club in history to enter administration, an automatic 9-point deduction that made relegation a near certainty. Unpaid tax had piled up to roughly £30 million. 2 years later, in February 2012, the club entered administration a second time, taking a further 10-point hit, by then already down in the championship. It kept falling through League One into League Two, and didn't climb back until 2017. Let that timeline land. A team that had just won a major trophy and qualified for Europe for the first time in its history was, within a handful of years, playing in the 4th tier of English football. Portsmouth isn't alone. Leeds United reached a Champions League semi-final in 2001 with a young, brilliant squad. Rio Ferdinand, Harry Kewell, built on money borrowed against gate receipts the club expected from Champions League appearances that never came. They missed out in 2002 and 2003. Debt climbed toward £100 million, and the club sold Ferdinand to Manchester United for £30 million just to survive. Leeds were relegated in 2004, and with one game left in 2006, 0-7, voluntarily walked into administration, taking a 10-point penalty and dropping to the 3rd tier for the first time in its history. Football has a phrase for it now. Doing a Leeds, borrowing against a success that hasn't arrived yet. And then there's the floor beneath the floor. Bury Football Club, founded 1885, two-time FA Cup winner, freshly promoted to League One, was sold in December 2018 for £1. 5 months later, it was up for sale again. On the 27th of August, 2019, a last-minute rescue deal collapsed roughly 1 hour before the league's deadline. Bury wasn't relegated. Bury was expelled, 134 years of history gone in an afternoon. That's worth sitting with. Relegation is football's black swan. Administration is worse. And Bury is the reminder that underneath even that, there is no floor at all. So, does actually owning a football club work? Does the money make sense? Look at the same club in 2 different years, and the honest answer isn't about how well the team is run. It's about the structure underneath it. Manchester United fell from 4th to 8th on football's global revenue rankings in a single season. Not because the business collapsed, but because the team missed Champions League qualification and finished 15th in the league. Broadcast income alone dropped from €258 million to to $206 million. Same club, same stadium, same sponsors. One trophy last season, tens of millions evaporated. Put that next to any normal business. A bad quarter costs most industries some margin. In football, a bad season can cost tens of millions you had no way to plan around. And yet club valuations keep climbing anyway. The average value of the world's 30 biggest clubs rose 21% in one recent year, even as most of them posted accounting losses. Real Madrid's own valuation has reportedly climbed from around $6.75 billion toward figures cited as high as $9.5 billion, alongside record-breaking revenue. And the strangest part? Analysts are explicit that this climb has almost nothing to do with football profitability. There's no salary cap, so the arms race for talent never stops, and that arms race has made football one of the least profitable businesses in sports. The valuation isn't paid for the football. It's paid for the brand and what it might be worth tomorrow. But actually, here's where it gets interesting. The smartest money in football has stopped pretending the football is the asset. Private equity now lends directly against the stadiums. The firm Apollo lent Nottingham Forest €93 million in 2025, secured against the club's stadium. Collateral that, as one analyst on the deal put it, retains its value regardless of whether the team ever qualifies for Europe. The building is safer collateral than the team inside it. Which brings us back to a building we've visited before. Tottenham Hotspur's stadium, the same one that left the club carrying £851 million in debt, has quietly become a business almost separate from football. The NFL pays Tottenham roughly £2 million per game to host American football there through 2030 and help fund construction because the pitch was built to NFL spec, retractable turf included. Concerts, boxing, corporate hospitality. £55 million in one recent season, with analysts projecting the number could reach $110 million a year once the venue is fully booked. Hold both halves of that in your head. The stadium that put Tottenham nearly £1 billion in a debt is, at the same time, building the club a second business with almost nothing to do with football, and under the sport's own financial rules, that non-football revenue counts toward how much the club is allowed to spend on players. The debt and the escape from the debt are the same building. Real Madrid's own stadium tells the identical story at the top of the pyramid. The renovated Bernabeu now generates an estimated 29 to 34% of the club's revenue from tours, concerts, and corporate events, not from a single match. The most successful club in the sport's history makes roughly a third of its money from people who never came to watch it play football at all. So, who actually wins this game? 3 owners, 3 definitions of victory. The state-backed owners in Manchester, Newcastle, and Paris are optimizing for reputation, not return. The private capital owners, Glazers, Clearlake, Ratcliffe, are optimizing for asset appreciation and extraction. The club can lose on the pitch while the family still collects the dividend. And the member-owned giants, Real Madrid and Barcelona, are optimizing for prestige and continuity for the fans who technically own them, increasingly funded by real estate and brand licensing, not football itself. None of the 3 is optimizing for make the football profitable, because none of them has to. The football was never really the business. So think back to where we started, the club nobody could buy, the trophy no amount of money could touch, sitting alongside the clubs that vanish for £1 and a signature. Not 2 different stories. The same bet, priced 2 ways. Pay in cash and hope the arms race doesn't bury you, or simply be the one institution the arms race can never touch at all. The next time you watch a match, really watch it. The players sprinting, the crowd on its feet, the ball hitting the net. That's not actually what you're watching. You're watching a brand renew itself in real time. You're watching a piece of real estate justify its own debt. You're watching a seat at a table of prestige and soft power get a little more valuable with every camera flash. The football is just what's showing on the screen, while the real business happens somewhere else. In a boardroom, in a broadcast contract, in a stadium ledger nobody in the stands will ever read.